The Tuesday morning wake-up call. Imagine it's a typical Tuesday morning. You're in your kitchen, the smell of coffee or chai fills the air, and your kids are busy arguing over their school gear. It's a scene of domestic stability, the life you've worked so hard to build in the United States. Then, your phone buzzes with an IRS notice of penalty. At first, your brain rejects it as a mistake. You're a hard-working, law-abiding person. But as you open the email, the subject line, unreported foreign financial account, followed by a staggering fine of $16,536 makes your stomach drop. Suddenly, that old savings account back home, the one with your mother's name on it that you barely used or honestly forgot, is no longer just a distant memory. It is a direct threat. You never imagined the U.S. government cared about a small bank account in India, Pakistan, Nigeria, or Mexico, but the reality of 2026 is that they do, and they are watching more closely than ever. The evolving surveillance of 2026. We have entered a new era where the system designed to find unreported foreign accounts is more powerful, more automated, and more unforgiving than it has ever been. This isn't just a financial issue or a simple tax fine. We are talking about a systemic shift that can directly jeopardize your green card, your citizenship application, and your entire reputation. Most immigrants step into this trap completely unaware, only realizing they are in trouble when the letter arrives. As an analyst, I see a pattern where hardworking people are caught in the crosshairs because no one warned them that America's reach extends far beyond its borders. Today, we move beyond the fear to provide professional clarity for green card holders and naturalized citizens alike. This conversation is not optional. It is an essential pillar of your financial and legal security in this country. Debunking the criminal stigma. Before we dive into the technicalities of FBAR and FATCA, let's establish a fundamental truth. Having a bank account in your home country does not make you a criminal. Supporting your aging parents, owning property abroad, or keeping a small inheritance does not make you a criminal. The danger lies entirely in the reporting mistake, not the existence of the assets themselves. Many people feel overwhelmed by legal confusion, but we are here to replace that panic with a professional shield of knowledge. We will explore the good moral character requirements for citizenship and the exact legal protections available for those who made honest mistakes. Silence is no longer an option when the IRS already has the data. The only path forward is understanding the rules and taking precise steps to protect your American future. The $10,000 misunderstanding. The first and most common layer of the reporting trap is what I call the $10,000 misunderstanding. Most people hear that number and assume they are safe because they don't have $10,000 sitting in any single account. However, the law is far more comprehensive. It doesn't care about the year-end balance, and it doesn't care about the balance today. What matters is the highest combined total across all your foreign financial accounts at any single moment during the entire calendar year. Even if that peak balance existed for only one day in January before the money was moved or spent, the reporting requirement was triggered. This is where most people unknowingly fail, assuming that three separate accounts of $4,000, $3,500, and $3,200 keep them under the limit, when in reality, they have crossed the threshold with a combined $10,700. The end of secret accounts, FATCA, and AI. If you are still operating under the belief that the IRS will never find out, you are thinking about the year 2005, not 2026. Under the global agreement known as FATCA, or the Foreign Account Tax Compliance Act, banks in over 100 countries are now legally required to report account data of U.S. persons directly to the government. Whether your account is in Delhi, Karachi, Manila, or Guadalajara, if your name is attached, that data is being transmitted quietly and automatically. Furthermore, the IRS has moved beyond manual audits. They are now deploying advanced artificial intelligence to cross-reference this foreign data with your domestic tax returns. They are looking for mismatches, interest income reported abroad that never appeared on your Form 1040, or foreign accounts that were never disclosed on an FBAR. The question is no longer if they can see it, but rather why you didn't report it first. Citizenship and the good moral character. Test. The stakes reach their highest point when you file Form N-400 for naturalization. To become a citizen, you must demonstrate good moral character, and your tax compliance history is a primary metric for this evaluation. During your interview, you will be asked under oath, Have you ever failed to file a required tax return? Or have you ever failed to report income? If you failed to file an FBAR when required and then check no on questions regarding tax compliance, you may have just made a false statement to a government official. This isn't just a paperwork error, it is a credibility issue that can lead to a denial of your application or, in serious cases, trigger a deeper investigation into intentional concealment. Most people in this situation aren't hiding money. They are just keeping convenience accounts for family, but the system interprets their silence as a lack of integrity. FBAR Deep Dive, FinCEN Form 114. The primary tool in your reporting arsenal is the FBAR, officially known as FinCEN Form 114. Despite being a tax-related document, you do not file it with your regular income tax return. Instead, it is filed electronically through the Financial Crimes Enforcement Network. The rule is rigid. If the combined total of your foreign accounts exceeded $10,000 at any point in the year, you must file. For the 2025 tax year, the deadline is April 15, 2026, though an automatic extension to October 15th is available. What constitutes a financial account is broader than you might think. It includes savings, checking, joint accounts, accounts where you only have signature authority, foreign retirement plans, and even certain insurance policies with cash value. Even if an account is dormant, if your name is attached and the threshold is crossed, the reporting obligation remains. The financial penalty spectrum. The cost of noncompliance is designed to be painful. If the IRS determines your failure to file was non-willful, meaning you simply didn't know the rule and had no intent to hide money, the penalty can still reach up to $10,000 per violation throughout, and which is often interpreted as per year. However, if they find the violation was willful or intentional, the penalties escalate to a devastating level, the greater of 100, 0, or 50% of the account balance. In the most extreme cases, criminal charges are possible. This is why the way you handle an error is just as important as the error itself. The system is built to punish silence after detection, but as we will see, it provides a pathway for those who choose to come forward voluntarily before the IRS knocks on their door. The streamlined filing shield. If you realize you've made an honest mistake, there is a professional shield available called the Streamlined Filing Compliance Procedures. This is an official IRS program designed specifically for people who fail to report foreign accounts due to negligence or misunderstanding rather than intentional concealment. If you qualify and come forward voluntarily, you can dramatically reduce your exposure. For those living in the U.S., the penalty is typically reduced to a flat 5% of the highest aggregate balance, while those living abroad may see their penalties reduced to 0. The critical factor here is timing. You must act before you receive an audit notice or a penalty letter. Once the IRS contacts you, this door slams shut, and you are left facing the full weight of the standard penalty structure. Form 8938 and FATCA reporting. Many people are surprised to learn that FBAR isn't the only form they might need. There is a second requirement called Form 8938, which is filed directly with your Form 1040. While FBAR focuses on bank accounts at a 10,000 threshold, Form 8938 has sugar thresholds and covers a broader range of specified foreign financial assets. For single filers in the U.S., you must file if your foreign assets exceed $50,000 on the last day of the year or $75,000 at any point. This form includes things that FBAR might miss, such as direct ownership of foreign stocks, interests in foreign businesses, or foreign trusts. It is crucial to understand that these forms are not substitutes for one another. You may very well be required to file both, and failing to do so creates separate cumulative penalties. The global tax reach, worldwide income. A foundational principle of U.S. tax law is that if you are a citizen or green card holder, you are taxed on your worldwide income. It doesn't matter if the money was earned in London, Lagos, or Lima. It must be reported on your U.S. return. This includes interest on foreign savings, rental income from property abroad, and business profits earned overseas. Now, this does not necessarily mean you will pay double tax. The foreign tax credit, Form 1116, allows you to offset taxes paid to another country against your U.S. liability. However, the requirement is disclosure. The U.S. system is built on transparency, and failing to report the income, even if no tax is ultimately owed, is viewed as a serious breach of compliance that can trigger the automated AI flags we discussed earlier. Why people freeze and why you shouldn't. When people discover they've missed years of reporting, the natural reaction is panic, and panic often leads to freezing or ignoring the problem. Some people attempt to quietly file back taxes without following the proper procedures, which is a dangerous mistake that can actually trigger an audit. The IRS knows that many immigrants are not criminals, they just didn't know the rules. That is why the streamlined procedures exist as an official pathway. To use it, you must certify under penalty of perjury that your conduct was non-willful, meaning it was due to a genuine lack of awareness. You generally file 3 years of amended tax returns and 6 years of delinquent FBRs. This process is about taking control of the narrative before the government takes control of your finances. The USCIS perspective on tax compliance. It is a mistake to think of tax issues and immigration issues as being in separate boxes. In 2026, USCIS and the IRS are in direct communication. When you sign your N-400, you are affirming that everything you've provided is truthful. Immigration officers are trained to evaluate patterns of compliance, not just single numbers. They can, and often do, request IRS tax transcripts directly. If the IRS database shows unreported foreign income or missing FBARs, and you've answered no to questions about tax compliance, you have created a major credibility issue. Even if the original mistake was innocent, a mismatch between your sworn answers and government records will trigger requests for evidence, RFEs, delays, or deeper scrutiny into your background. Case study: the property sale spike. Let's look at a practical scenario that plays out for many immigrants. Imagine someone who became a green card holder in 2018 and kept a joint account with their father back home. The balance was always small until 2022, when some family property was sold and their share, about $15,000, sat in the account for a few weeks before being distributed. They didn't know about FBAR because they didn't think of that money as income. Now, in 2026, they apply for citizenship. During the interview, the officer asks about foreign income. If this hasn't been corrected beforehand, the applicant is left trying to explain a complex financial transaction on the fly. The officer may continue the case, requesting years of proof, turning a celebratory milestone into a months-long period of high-stakes stress. The danger of willful classification. If the government believes you intentionally hid your accounts, the situation shifts from a technical error to a legal crisis. Willful conduct includes things like structured transfers, making small deposits to stay under thresholds, providing false explanations to the IRS, or submitting incomplete disclosures after you've been contacted. In these cases, the good moral character requirement for citizenship is almost impossible to meet. USCIS can deny your application on the spot. In rare but extreme cases, if it is discovered after you become a citizen that you obtained your naturalization through the concealment of material facts, like a major unreported foreign account, the government can even initiate denaturalization proceedings. This is why honesty and proactive correction are the only sustainable strategies. Pre-application compliance audits. If you are on the path to citizenship, your goal should be to walk into that N-400 interview with total confidence, not just hoping no one notices an old account. The law does not require perfection. It requires honesty and corrective action. Before you submit your application, I strongly recommend a citizenship compliance audit. Request your IRS tax transcripts for the last 5 years and review them carefully. Confirm that all required FBARs were filed and that all foreign income was reported properly. If you find a discrepancy, fix the problem before you file for citizenship. A prepared applicant who has already amended their records and paid any owed taxes is viewed as responsible, while an unprepared one is viewed with suspicion. Case study: choosing correction over silence. Consider the difference between two individuals. One man realizes he missed a temporary spike in his foreign account balance when family land was sold. Instead of ignoring it, he works with a professional to file delinquent FBRs and document his non-willfulness before applying for citizenship. His interview is a non-event. The issue was already resolved. Contrast this with another person who receives an IRS notice and ignores it, hoping it will disappear. By the time they finally respond, the IRS tone has shifted to adversarial, interest has accumulated, and their willfulness is being questioned. The lesson here isn't fear, it's timing. Silence makes small issues bigger, while proactive handling keeps you in control. Your step-by-step compliance plan. Tonight, I want you to start a simple checklist to protect your future. Step 1. Create a complete inventory of every foreign account where your name appears, savings, checking, joint, or even just signature authority. Step 2. Determine the highest balance each account reached at any point during the year. Don't just look at December 31st. Step 3. Add those peaks together. Did the total exceed $10,000? If so, mark your FBAR deadline for April 15th, 2026. Step 4. Check the higher thresholds for Form 8938. Step 5. Review your worldwide income for any interest or dividends that were missed. Finally, if you find gaps, evaluate the streamlined procedures immediately with a qualified tax professional. The emotional shift from fear to dignity. For many immigrants, contact from government agencies triggers an instinct of avoidance due to experiences in their home countries. But in the U.S., the system, while strict, is structured with defined procedures, appeal rights, and penalty mitigation programs. It rewards transparency. You must also remember that having financial ties to your heritage is a matter of dignity, not suspicion. Supporting parents or inheriting property is a normal part of a global life. The tax system exists for transparency, not to punish your background. Once you shift your mindset from hiding to handling, the issue becomes a technical hurdle that can be cleared rather than a personal threat to your identity. Summary: the 3 rules of protection. As we conclude this analysis, I want you to memorize 3 professional rules for 2026. Rule number 1. If your combined foreign account balances exceeded $10,000 at any moment, you must file an FBAR. Rule number 2. Always come forward voluntarily before the IRS contacts you. It is the difference between a manageable 5% penalty and a life-altering 50% penalty. Rule number 3. Tax compliance and citizenship are permanently connected. Always review your tax record before filing your N-400. You have worked too hard, crossed too many oceans, and passed too many tests to let a reporting oversight undo your progress. Preparation is power, transparency is strength, and action is your ultimate protection.